So if you look at this chart, it's important to recognize that a normal real return to stocks is somewhere around 4.5, 5, maybe 5.5%. So you're getting paid better than that for owning value stocks outside of the US for sure. The other thing to note about this chart, as it says on the left-hand side, is these are real return forecasts, and they're also in local currency. Now, since the US dollar looks quite expensive, that tends to be a tailwind for US investors who are owners of non-US assets. So we think the expected returns from these blue bars should be augmented by an expected currency return that pushes some of these 6 or 7.5% returns up closer into the high single digits, low double digits.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I always say the most valuable people to interview are capital allocators because they've got to answer to their clients for their market calls. They're judged not by their opinions, but by their results. So today we're fortunate to hear from one of the most respected capital management firms in the world, Grantham, Mayo, Van Otterloo, otherwise known as GMO, which was co-founded by the great investor Jeremey Grantham and currently manages over $65 billion worth of client assets. Specifically, we're sitting down with John Thorndike, co-head of asset allocation, who co-manages GMO's dynamic allocation and international value ETFs. We'll discuss GMO's outlook for 2026 and where the firm sees the biggest risks and opportunities for investors. John, thanks so much for joining us today.
Thanks for having me, Adam.
Well, it's a real pleasure, John. And you may look familiar to some of the viewers here because you spoke at Thoughtful Money's spring online conference this year. This is your first appearance on the public channel. So very excited for that. We have a lot of people who are huge fans of your co-founder there, Jeremey Grantham, and very interested to hear what his firm is thinking these days. And we got a lot of great feedback when you appeared on the conference early in the year. So I know folks are going to be excited to have you back, at least those who've seen you before. Really quick, before we dive into the discussion, I just want to give a little caveat. As a lot of my audience who follows me on the social media knows, I'm on day 5 of a 5-day fast right now, and I actually feel fine. But if I start slurring or pass out or anything like that, don't take it personally, John.
Sounds good. That's quite a feat.
Okay. It's a quick way to get a lot of undue respect from a lot of people is to tell them that you're doing a fast. It really isn't as crazy as it sounds, but to a lot of people, they're just like, I cannot believe you're doing that. And trust me, dude, I enjoy all the kind words and praise, but I feel like I deserve almost none of it. But enough of that. So look, a lot to talk about with you, John. As I mentioned, several times already, your firm is just highly respected. So why don't we just start with this? What is your, and taking into your answer kind of what you know of GMO's perspective as well, what is your current assessment of the global economy and financial markets?
I'd say on the economy, in a word, uncertain. I mean, we have been living in highly uncertain times. That continues today. We don't know where policy is headed. We don't know how many parts of the economy are reacting to changes in the labor force, changes in tariff policy, changes in immigration enforcement, what may be coming from the Supreme Court on tariffs. So many uncertainties that as financial market investors, we continue to do what we've always done within the GMO asset allocation team, which is let valuations be the guide to us of where the best opportunities are and where the most worrisome risks are in markets. And there, I'd say in terms of financial markets, probably the word would be dispersion. There are some parts of the markets that to us look quite risky and worth staying away from. And there's certain parts that are worth leaning into. So, we can go back and talk about how today's environment compares to other periods in time that have been interesting inflection points in markets and maybe compare and contrast some of those. But today very much feels like an environment where there's a lot worth doing and some parts of the markets that are definitely worth avoiding.
Okay. Well, why don't we just go right there? So if history rhymes, what is this current cycle making you think of in terms of past periods?
Well, I know it's quite a analogy to draw, but probably the closest time period that this feels like to us is the tech bubble around 2000. If you think about that market environment, obviously there were some very frothy parts, the TMT sector at the time. But the thing about 2000, there were a lot of great investment opportunities. You could buy REITs at high yields. You could buy old industrial companies at attractive valuations. You could buy small caps. You could buy non-US stocks. You just had to avoid the, internet darlings. And today feels a lot like that as well. We think you get paid well for owning stocks outside the US. We think there's some value stocks within the US that can pay you all right. The fixed income market in terms of interest rate duration certainly has some risks associated with it, but you're getting paid okay. Credit might be another place that we would stay away from. We can talk more about that. But if you contrast that to the other more bubbly times that we've lived through over the past 20, 25 years, 2008 was an entirely different bubble-like environment. That was an environment where one thing that we look at is what we call the risk curve. So we look at different asset classes and assess our forecasts against the risk or the volatility of that asset class. And in 2008, the slope of the line of best fit of those forecasts was negative. If you took more risk, you expected to earn less return. So the right thing to do in 2008 clearly was just go and hide. Like we went and hid in quality stocks and in safe fixed income, cash, treasuries, those sorts of things. That's not the environment today. The environment today, you still get paid for taking risk. You just need to avoid US large cap growth. So today doesn't look like 2008. It also doesn't look like 2021. 2021 was an environment where expected returns everywhere were very low. Right? You were getting paid next to nothing, negative real yields for owning treasuries. You were getting paid very little for owning risk assets, especially outside of emerging markets. So in 2021, basically anything with duration looked expensive. And the thing to do back then was hide, and we thought liquid alternatives. We had 60% of our portfolio in liquid alternatives back then. So, the market does get over enthusiastic about different themes from time to time, but history isn't always analogous to the last time we had a bubble. We think this one looks a lot more like what we faced in 2000 than it does in 2008 or 2021.
All right. So would it be fair to say that unlike 2008, which was a bubble, which was just go and hide, unlike 2021, which you could say was sort of a valuation extreme as well, where there just really weren't any really good opportunities, so you hung out in T-bills or liquid alternatives. Would you want to call this one like a demi bubble or a half bubble, where it's like some parts too are valued you don't want to go touch, but good opportunities in some other areas?
Yeah, I'd say maybe it's a concentrated bubble or a focused bubble, right? It is really anything associated with AI today looks like it has a lot of enthusiasm priced in, let's put it that way. But the further that you venture away from that theme, we think that you can earn attractive, even high double-digit returns from some non-US value stocks. And that's just markedly different than the environment looked like in 2021.
Okay. John, as you're talking here, I'm just going to pull up a chart from one of GMO's recent reports here, which is showing the 7-year asset class return forecasts.
Yes.
So this does sort of track well with what you just said, right? Which you said, you're seeing some parts of the market that you should lean into. And here it looks like, deep value, international deep value for sure, but US deep value as well. They all seem to have pretty good 7-year average real return forecasts, while the US large caps in particular have pretty pronounced negative ones. And I'm guessing because the Mag 7, make up so much of the performance of the US indices that they're basically dragging the US large caps down.
It's some of the Mag 7. but it's also just a much broader set of US stocks. In fact, my colleagues looked the other day at developed market equities, so US and developed non-US stocks. And what they did was they went and they broke the whole global market up into deciles based on what do analysts expect the next 2 years of earnings growth to be for any given company. Right? So they took the market, they broke it up into 10 different deciles on analyst expected earnings growth. So not GMO's view, just what does the street expect? Each bucket has US stocks and it has non-US stocks. So fastest growers might have a DoorDash in the US, but would also have, say, a Spotify outside of the US. And we looked at the valuation discount of non-US stocks relative to US stocks in each of those deciles. So basically comparing like to like expected growth. And you would generally find non-US stocks at 40, 50% discounts to the US counterparts, even ones that had same expected growth. So this isn't just about 7 stocks. Some of those 7 stocks look cheap to us. Some of them look quite expensive. But it's really about this priced in assumption about US exceptionalism that drives those forecasts for the US markets down. And it's completely lacking from non-US markets. So if you look at this chart, it's important to recognize that a normal real return to stocks is somewhere around 4.5%, 5%, maybe 5.5%. So you're getting paid better than that for owning value stocks outside of the US for sure. The other thing to note about this chart, as it says on the left-hand side, is these are real return forecasts, and they're also in local currency. Now, since the US dollar looks quite expensive, that tends to be a tailwind for US investors who are owners of non-US assets. So we think the expected returns from these blue bars should be augmented by an expected currency return that pushes some of these 6 or 7.5% returns up closer into the high single digits, low double digits.
All right. Okay, super interesting. Looking forward to getting this more deeply with you. Let me just ask you this real quick. So much of the S&P and a great deal more of the NASDAQ is made up of companies that have a ton of their valuation in AI, right? So I guess first off, is your base case that the AI sector just kind of cools and these stocks just kind of flatline or maybe go down a little bit, right? Or is it, do we get those -6% returns, real returns over the next 7 years because there's some massive repricing downwards like we had in the dot-com bubble when the world just said, you know what, we've overbuilt, we overestimated. Yes, this thing probably will deliver a lot of the benefits we think it will. They're just going to take a lot longer to manifest. And if it's the latter, where you think it's more likely to be kind of a big correction, because these stocks make up such big percentages of the market, can they correct without kind of taking everything down with them, at least in the near term?
So, the market doesn't tend to just move in a straight line as it figures these things out. Right? So, well, it may be the case, indeed, it probably will be the case that AI is a game-changing technology, right? The internet in 2000 was a game-changing technology. We all do things now that we couldn't do 25 years ago.
Undoubtedly.
Right? So the thesis was ultimately right, just the pricing was insane. I think that today, the thesis is probably right, that we will all be using AI even more than we already are. But the expectations have probably run way ahead. And when those re-rate, I suspect you'll see, a more violent price reaction than even the fundamentals would necessarily warrant. And so you won't just see people re-rate these stocks down a little bit at a time. If you look at what happens to the market based on its starting valuation doesn't really tell you a lot about what's going to happen next month or next quarter. But it does tell you that when you start at a high valuation and stocks go up, they don't tend to go up by as much as they usually do. And when you start at a high valuation and stocks go down, they tend to go down by more than they usually do. So
Hmm.
high valuations, low expected returns, high expected risk. There's just a lot is already priced in.
All
Um,
right, so we're going to talk in depth about why you like value and international stocks in just a moment. The reason why I asked that question was, let's say you convince viewers here during this discussion, okay, GMO is really onto something here. I want to start considering value stocks and international stocks. Is it the kind of thing where they should be, building positions now, or is it the kind of thing where they should say, well, let me wait for kind of this mania that's over to get played out in the AI space and let the market do whatever it's going to do, maybe sit in safety until then. And then once, the ripple effects of that begin to die out, then I'll go in and buy this stuff. In other words, I know these things are trading at much greater discounts relative to the AI stocks, but might it make sense, or is there a risk of buying into them now and then have them correct, maybe not 30, 40% like the AI stocks might, but 15, 20%. And maybe if I just waited, I could wait for all that carnage to end and then start buying in. Do you have a strong opinion one way or that? I know I'm asking you to kind of guesstimate a lot here.
yeah, my opinion is that's really hard to do, right? That owning cheap stocks that end up trading cheaper hurts, right? Nobody likes looking at their account and seeing that you've taken a loss on a position. But you've bought it at a reasonable price, earning a reasonable earnings yield or dividend yield or buyback yield, whatever it is. And you continue to have the right to that cash flow stream, even if it's gotten priced down to a lower level. What's hard is if you think back to when the tech bubble broke in the US, uh, over periods where the US was coming down, emerging markets, which tended to be high beta stocks, actually made money over some of those periods of time, right? So the market has the ability to differentiate and say, this is a problem over here, and it's not a problem over here.
Hmm.
And so, well, some of the viewers might see that and think, oh, I'm going to wait for the correction and then I'm going to be the first one in. Well, there's a lot of smart people who will out there be trying to do the same thing at probably the same time. And maybe you'll beat them, maybe you're not. If you buy stocks today at reasonable valuations, when you come back and you look at your account 10 years from now, you're going to have made a decent return.
Okay. So when you talk about reasonable valuations, are the value stocks and international stocks right now, are they reasonably valued on an absolute basis or just reasonably valued relative to the overpriced, stocks that we've been talking about?
So value stocks outside of the US, we think are definitely priced at reasonable valuations in absolute terms, right? You saw those forecasts of 6 to 7% real, add a
Yeah.
couple points on for inflation, add a couple points on for the currency, and you're talking about earning low double digit returns on equities.
Hmm.
That's completely consistent with what equities have delivered historically. Value stocks in the US is a bit of a tougher absolute return argument. We think that there are some of them that are priced to deliver you a reasonable absolute return. They're a much better relative value trade, though, than they are an absolute value trade.
Okay. Okay. So fair to say that even though you like US value right now, you like internet value more?
Yeah, so if you look at our multi-asset portfolios, we have significantly more money invested in non-US value stocks than we do in US value stocks.
Okay. And you got to forgive me, I have not looked at the performance history of international value stocks prior to this interview. How have they done in recent years?
So our international value strategy is up about 35% year to date. So it's kind
That's
of
pretty good.
startling. Yeah, it's kind of startling to see something that's up that much still look really cheap. It's one of the cool things about value is value doesn't need its discount to the market to shrink in order for it to perform well. Because what can happen is value recycles. I think we talked about this for your conference last time
Yep.
we spoke, is that, if I'm a value investor, some of my stocks end up doing better than expected. I sell them to you at a premium. I buy your disappointment stocks at a lower price, and I just keep churning things along. So we've had a bit of that in our performance where we still have a portfolio that's trading at a deep discount relative to the broad market, yet we've managed to deliver pretty good returns.
Okay. Wow. That's super exciting. Well, so looking internationally right now, which countries slash regions interest you the most right now?
We've done really well by the European banks. I think our portfolio of European financials this year is up something like 85%. That's a place where we've made some of the easy money, we think, and we're trimming back. But we like some of the Japanese industrial companies. We like some of the global pharmaceutical companies that are traded outside of the US. We like some of the ones that are inside the US as well. I think pharma is a good example, though, of what we mean when we talk about value. Doesn't just mean a junky company that's trading at a very low price to book,
Hmm.
right? For us, value is you're trading at a steep discount to an intrinsic value of what your company is actually worth. And we think some of the pharma companies look lots of near-term risk around drug pricing, around insurance pricing, certainly here in the US. So there's always plenty of hair around value names, but they're not your traditional deep discount on price to book opportunity.
Okay. And okay, so European banks, Japanese industrials, global pharma. I know there's more than this in the portfolio, but you're being kind and giving us kind of your big themes here. Can you just give us, if you can, just a quick like rationale for each one of those things? So what has made European banks perform so well this year?
Oh, part of that was just very low expectations going into the year, right?
Okay, they were just so beaten down.
Everybody thought the European economy was a mess. Europe generally a mess. Uh, Price to book was significantly below one for many of these companies. And what's changed, I think, is a thesis around, okay, if Europe is going to reindustrialize, if Europe is going to build out a defense sector, somebody's going to have to finance it. If Europe is going to be doing a little bit more fiscal, that's going to lead to more growth. And even these small changes on the margin, when you've got banks trading at significant discounts to tangible book, that can lead to pretty violent price moves upwards.
Got it. Okay. How about with the Japanese industrials?
The Japanese industrials, I think, have also benefited from some of thesis around supply chains moving away from a concentration in China,
Hmm.
have moved a bit from the defense theme as well. And then Japan has just generally caught a bid. We think it's a country that deserves to outperform from here as well. A lot going on the ground in terms of corporate reform, pressure from the stock exchange as well as the government in terms of getting rid of cross shareholdings, of better use of balance sheet. So there's some themes in Japan generally that I think have benefited some of those companies as well.
All right. So sort of Japan cleaning up its act and benefiting from the move away from China. Is it the same with global pharma? Pharmaceuticals have been at the one of the issues near the heart of the U.S.-China trade issues. Is this just other China's business for pharma maybe going to some other countries?
I think more there, uh, the theme is really about these are high quality businesses that have short term questions around them, where their history is generating a very good return on capital. And so we think that they uh, are high quality companies that are trading at around a market multiple and deserve to be trading a little bit higher than that. So
Okay.
they've performed okay. They haven't performed as well as the European banks or the Japanese industrials have, for example. So we think that's
Hmm.
still an opportunity of value there.
Okay. One more region, and then I'll get to a more thematic question. I didn't hear India from you yet. That was a country that had done kind of great over 2024 through a lot of 2025. Is that a place you're still interested in, or did that just get too overpriced?
India has generally been one of the emerging markets that we've found expensive. So as we have found value to be particularly cheap, it's been one of the countries that we've been more underweight relative to overweight.
Okay. And in your back to the chart that we showed a few minutes ago, um, you mentioned that a continuing to weaken dollar would be a tailwind to the returns for those countries, right? First off, do those real returns you had on there over the next 7 years, do they make an assumption about the direction of the dollar, or do they just say, hey, if the dollar sort of stays where it is, this is what we'll get, and then it could be better or worse based upon how the dollar performs?
It's more the latter. So those are local forecasts. So they don't make an assumption about where the currency is going to go. What you've tend to find historically is that stocks that trade in countries with cheap currencies tend to get a tailwind for one of two reasons. Either the currency appreciates, moves sort of back towards fair value, and you get a benefit from that,
Hmm.
or the companies benefit from having a cost advantage.
Right.
So you either will tend to see faster earnings growth or a currency re-rating. And so when we do our forecasting in US dollar common currency space, we'll add a little bit above all of those blue bars that you showed on the chart for the dollar's current expensiveness or the cheapness of the other currencies.
Okay. So what is GMO's expectation for the dollar from here? Does it expect it, and you can tell me whether it's easier to predict over the next 7 years or whether it's easier to predict over the next 7 months. To tell me which you guys are thinking.
Yeah, we generally think it's a lot easier to predict over 7 years than 7 months.
Hmm.
And we think that the dollar continues to trade expensive relative to a basket of other currencies. So it's definitely come down, obviously, this year relative to where it was starting the year, but
Hmm.
it remains expensive. Uh, and when you add on to that, pressures around, we continue to see inflation running at a relatively high rate here, and have increased questions about what is the Federal Reserve willing or able to do in the context of that sustained inflation, but also a slowing economy. Um, uh, those can put pressure on the dollar as well.
Okay. So sorry, but is that just saying over the next 7 years, you sort of expect a progressive weakening of the dollar versus other currencies?
Yeah.
Okay.
Yep.
And since you mentioned it, what is your take on the Fed ending QT, having restarted a rate cutting cycle without inflation being down at their 2% target? Do you expect inflation to be sustained going forward then?
I think it's uh, I think it's hard to believe that they are really insistent on getting to 2% inflation if you look at their current actions. Now, is 2% a magic number that you have to get
Right.
to?
Mhm.
I'm not convinced that it is. What we tend to look at is, okay, let's just imagine that we're not in a world of 2% inflation, but we're in a world of 3% inflation. Well, if you've got treasuries trading at 4% at the 10-year, roughly 4 to 4.25, you're still getting 100 basis points over inflation, maybe a little bit more. That's okay. That's a reasonable return from, say, fixed income. If you get a recession, obviously inflation will come down, and there's room then for your bond yields to come down. So we think that treasuries, even if the Fed isn't targeting two, maybe it's targeting 2.5, but won't say it, you can still do okay with treasury bonds.
Okay, let me ask you this. So, uh, you mentioned slowing economy, and there has been data throughout 2025 to suggest that the economy is continuing to slow. Now, granted, we've been flying a little bit blind in
Yeah.
recent weeks because of the government shutdown. Um, you also mentioned that your word for the economy was uncertainty, right, or uncertain, right? And I agree with that, though I think we now have more clarity on exactly what policies the administration, certainly more clarity than when you and I talked last back in, March. A lot more clarity on exactly which policies of the administration are going to be A, put forth, and B, like approved and get underway. And a number of them are now, right? So we've had the tariffs. Still TBD exactly what their long-term impact's going to be, but we know that it hasn't brought inflation back to 5 plus like a lot of people were fearing. We know what a number of the trade deals look like now, and hopefully some of the other really big ones, might get struck fairly soon, right, or finalized fairly soon. We know that what's in the one big beautiful bill in terms of deregulation and tax cut extension and some additional tax relief. So, we do have some more clarity. And if I'm sure if we had Treasury Secretary Dissent in this conversation, he would say, "Get ready, guys. All that stuff's going to start producing tailwinds for the economy, in the next year." What do you think is more likely to win out, the slowing of the economy, or a recovery or tailwinds from these policies?
It's very hard to say, right? In addition to what you cited, we've got a significant reduction in the labor force,
Hmm.
right, through immigration policy. And we've got a ton of CapEx that's going on related to data center build
Hmm.
out, to the point where I think that data center build out is driving a significant fraction of GDP growth.
GDP growth. That might be the thing that trumps everything. Is that what you're saying? Like,
If that were to slow, and right, uh, we're building out these data centers on promises from AI to spend money that it doesn't yet make, to buy chips that NVIDIA doesn't yet make, to put into data centers that aren't yet built, powered by energy that we haven't yet produced. If any of this slows down, what does that do to the macro numbers? I think that we have to have a lot of uncertainty about that.
okay, and that makes sense to me. So I guess let me ask you this then. So a year plus ago, I remember listening to warnings that your co-founder Jeremey Grantham was putting out there about an asset bubble in the equity markets. Um, I think it's fair to say those concerns are still as true to the points he was making then are still as true today, maybe even more so given how things have grown since then. How concerned is GMO about not just sort of a leveling off of AI, but of a real correction? We talked earlier about the potential implications if there was a correction, but I mean, how concerned are you that this sort of ends in tears, at least in the near term, for the markets, if the AI bubble, if there is a demi bubble in this market, concentrated in AI, does pop?
I mean, there's various views throughout the firm.
I bet there are.
Uh,
Yeah.
so that caveat aside, I think that if you got a big deflation of that bubble, you would see a lot of pain in the US market. To your point earlier, you would probably see some pain outside of the US. That ex-US would be a great investment opportunity. Um, but I guess one way to think about it is, all right, GMO, what are you guys actually doing with your money?
Hmm.
Right? So I can tell you in our unconstrained benchmark free strategy, which you know doesn't pay attention to any benchmark as we build the portfolio, but over time we think it ought to beat a 60-40 portfolio, so a traditional balanced portfolio that's 60% equities, 40% bonds. In that portfolio, we've got a little under half of the portfolio invested in stocks. Almost all of those are non-US value stocks. We have a small allocation to the USD value names that we really like.
Okay.
So we're about 50% in stocks. At the end of 2021, we were less than 30%. So, in terms of how much risk are we taking? We're not taking a normal amount of equity risk. We don't have 60% or more, but we do have almost half of the portfolio in equities. We've got a lot of the portfolio in liquid alternatives, so in relative value trades. And then we've got some treasury exposure. We have barely any credit risk in the portfolio at all. So we own a portfolio that we think is capable of earning returns. Now it's up something like 18% this year, so it's actually outperforming the S&P, which isn't a good benchmark for the strategy, but I
Hmm.
throw out there just because. um, but it's a portfolio that we think is avoiding the most risky parts of the market.
Okay, great. All right. So you guys aren't hiding. You're not down in the bunker. You're
Nope.
not guns a blazing either. but you're basically saying, hey, we think there's acceptable risk to take in this market. It's in these areas, and you've already mentioned a number of them. You did mention we got barely any credit risk. So let's talk
Yeah.
about that for a moment. So what is, correct me if this is the wrong word, but what is spooking you guys about credit markets right now?
It's really that you're just not getting paid for taking risk. Right? If you look at spreads, so the incremental yield that you're getting for owning a credit instrument above a treasury bond with the same duration, in investment grade, I think it's around 80 basis points, which is about as tight as it's ever been. So about the smallest amount of incremental return you've ever been paid for taking investment grade risk. In
Hmm.
high yield is probably in the cheapest 10% of the time, maybe 20%. It's about 300 basis points of incremental spread. So why take risk where you have very little upside, significant downside, where instead we can go over to those markets outside of the US where we were just talking about, maybe put fewer dollars to work to have the same amount of risk exposed, but you've got much more upside
Right.
and we think long term less downside. So,
Okay.
yeah, credit markets are a place where you really should vary your exposure based on how much you're getting paid. And today you're not getting paid very much.
All right. And so, yes, credit spreads, especially for, prior to 2 months from now, I mean, you could almost not see any daylight between, the treasuries and corporate credit.
Yeah.
Um, but so let me ask you this: which is it more of? Um, I'm just not getting paid for the risk, or is it I'm not getting paid well and I think the risk is actually pretty substantial? I ask that because we have seen of late um, some signs of concern beginning to appear in the credit markets, right? We've
We've
seen the
seen a
repo,
cockroach.
we've seen cockroaches, we've seen repo lending blowout. So, nothing right now that suggests, credit crisis, but it does suggest that all isn't perfect in the credit world.
Yeah. And I'd say, as we look at things, we agree that you tend to uh, risk builds up when everything is looking good,
Hmm.
right? The risks in credit markets don't start when the market blows out. They were made when the loans were made against bad collateral at a bad price. So I believe that there is risk in the credit markets today. I don't know when it will reveal itself, but I do know that you've been able to pass off that paper to somebody else at a much lower spread than where we had bought it previously. So I'll let them realize the risk, and then when they no longer want it, I'll buy it back. Uh,
All right, makes total sense. All right, well, look, let's get to the fun part. So, um, imagine given not just your outlook, but the outlook of the firm as you've described it, this is going to be kind of a fun time for you, given the ETFs that you manage, correct?
yeah,
This is
absolutely.
kind of where the firm's, excitement is for the next 7 years.
Yeah, we're excited about the ETFs, and in particular, I'm excited about the ETF that we just launched last month, which is called the GMO Dynamic Allocation Fund. So it launched on the New York Stock Exchange, ticker GMOD. And that strategy we set up as a multi-asset ETF of ETFs. Um, what struck me as we were thinking about this idea was people came to us and said, "Hey, GMO, have you thought about putting out model portfolio allocations?" Right?
Hmm.
So you go out and say, "Hey, people, I think you should have this much in fund A and that much in ETF B, et cetera." And I don't know if this is right, but I think there were something like 6,000 of those different model portfolios out there. And I'm like, we could be the 6,000th and first, um, but as we've built our active equity ETF business, and I've learned more about it, I was thinking, why is it that these active ETF equity managers can reallocate their portfolios? So they want to sell out of Microsoft and buy Apple. They can do that without incurring any taxes. Why can't I do what I do, active asset allocation, using the same tools and suddenly be able to do dynamic asset allocation? So shift from the US to Japan or Japan to Europe or value to growth, whatever, taking advantage of the ETF structure without necessarily having to realize taxes along the way. why wouldn't we launch a multi-asset ETF? So that's what we did. It's benchmarked against a 60/40 strategy. Probably wouldn't surprise you given everything I was just talking about. Today, it's taking a pretty normal amount of equity risk, but most of it is outside of the US. It has exposure to GMO's value fund in the US and outside, GMO's quality fund in the US and outside, as well as another ETF we launched recently called the Domestic Resilience Fund, which aims at investing in companies here in the US that stand to benefit from some of that supply chain shift away from China.
What's that ticker, by the way?
That one is DRES.
All right.
So we've got those exposures. We've got them complemented with some ETFs from outside of the firm. I just want to be clear, when we charge our management fee, we credit off any management fee paid to others. So there's no stacking of fees in the product.
Got
So
it.
we use our ETFs and others' ETFs to build the portfolio. And we think it can be dynamic and diversifying and also quite tax efficient.
All right. Makes a ton of sense. So can you give the ETF for your international value ETF as well?
Yeah, so the international value ETF is GMOI, and the US value ETF is GMOV. We're not super creative with the tickers.
I like it. I keep it simple and easy. All right. Well, fantastic. So we're going to start wrapping up here in just a moment, but is there anything that is burning brightly on your radar that I haven't thought to ask you about yet, John?
I mean, one thing people often ask us about is, okay, you see a bubble or you see a highly priced market, what's the catalyst? And you've
Yep.
been kind enough not to ask what the catalyst is because it's always a difficult question for us as value investors.
Because it's usually the bullet you don't see coming, but yeah, go ahead.
Yeah, exactly. And that's exactly right. But you're starting to see signs, right? I think it was Matt Levine and Bloomberg who was noting that the OpenAI business strategy is to create machine God and then ask it how to make money, right? Like, you don't hear stuff like that at the bottom of a market. Right? Uh, you've got the potential for OpenAI going public at $1 trillion valuation. Now, surely all of that won't free float, but if a significant amount of it free floats and index funds have to buy it, then they got to sell the rest of their stuff. Who are they going to sell it to? When the institutions who have these concentrated portfolios that they've been dying to get distributions from their private portfolios, once they get those distributions and lockups come off and they can sell those stocks, who are they going to sell it to? Well, I'm sure they're public market investors who are excited to have OpenAI in their portfolio, but they're not sitting there holding cash waiting to buy it. Maybe they're holding NVIDIA. Maybe they're holding Microsoft. Well, if you want to get a value investor like me to buy NVIDIA off your hands, it's going to take a lot lower price than where it's trading today. And given how much passive money there is in portfolios, the number of active managers who are really willing to step in and change their portfolio to buy some of these stocks that folks might need to offload in order to buy the new IPOs, that could be certainly a source of pressure on markets. So we're starting to see signs, Adam. I don't know when any of this is going to end, but maybe Machine God will tell us.
That's a really interesting way to put what they're doing. And of course, there's no guarantee whatever question we ask Machine God that we're going to like the answer we get either.
That's right.
All right. Well, look, I asked you this at the conference, but since it was a smaller audience that is watching now, I'm just going to ask it again. What's it like working with access to Jeremey Grantham? I don't know if he still comes into the office every day. I mean, I guess he doesn't. But what's it like to be able to have access to that mind and all that experience?
Well, Jeremy's not in the office every day, but we did just have our client conference last week, and he was up on stage telling some stories. And I'll tell you, one of the things that's always really struck me about Jeremey is just how driven he is, just how competitive he is. he was still naming names of people who called him, wrong but dangerously persuasive back before he was, of course, just about to be right. Was showing us hand-drawn charts of valuation spreads from way back in the day. Just really independent-minded, really driven, funny, and I'll put in a shameless plug for his book. Jeremy and Ed Chancellor are just about to publish. I think you can get a pre-order your book if you want to. I think it's called The Making of a Perma Bear, but it's Jeremey Grantham and Ed Chancellor. They've got a book coming out telling stories of his career. I'm sure it will be an interesting read. I'm hoping there's a copy that shows up on my desk this week.
Awesome. If it's available for pre-order and there's already a jacket cover of it, I'll put that jacket cover up on the screen when I edit this, when you mention it there. Also, just so you know, I will, when I edit, put up the tickers that you mentioned on the screen too, so folks know where to go. Folks, I'll have those tickers in the description below this video as well. All right, well, look, last question before I do a little housekeeping, and then I'll give you the last word, John. Beyond the tickers that you just mentioned, and perhaps going and reading Jeremy's book as soon as it's available, where can folks go to learn more about you and your work and the work of GMO in general after this discussion?
Sure. So we publish our work on gmo.com. Some of it is behind a login, but you just need to register. It's free and you can get access.
All right. Awesome. All right. Well, look, very quickly, folks, please join me in thanking John for coming on and giving us such great insight, and particularly giving us a view as to sort of how things work there in GMO, but very specifically how to take advantage of the opportunities that they see through their ETFs. Please join me in thanking him for that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Look, if you're a DIY investor and these things excite you, definitely go and research these ETFs and opportunities that John have mentioned, see if they might make sense in your portfolio. If you are somebody who prefers to have a financial quarterback help you make those decisions, then obviously ask your financial advisor their thoughts. Are they appropriate? If so, what percentage of their portfolio should they be? If you don't have a good financial advisor to bounce those questions off of, feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These discussions with these firms are absolutely free. There's no commitments involved. It's just a service they offer to help as many people as possible. All right, John, again, can't thank you enough. Really look forward to, if you're willing, have you back on in 2026 to give us sort of an audible update as to how things progress on your current outlook here. The last question for you is, we do have professional investors that watch this channel, but most are just, regular people, many of whom who have worked hard or are working hard to build wealth to provide for their family's future. They want to grow their wealth prudently, which is why I think they really appreciate some of the opportunities you just gave them to consider. But most importantly, they don't want to become collateral damage to some sort of market drawdown and lose a lot of valuable time. You've mentioned a little bit about your thoughts, but any parting bits of advice for those people?
Probably the one that I'd repeat is just this notion that the higher the price of an asset, the lower the expected returns and the higher the risk. So be careful getting swept up in a lot of enthusiasm. If you aren't really studying markets and studying companies, owning a diversified portfolio that's well balanced, it's going to serve you well in the long run.
All right, very well said. And again, I can't thank you enough for coming on and sharing so much, John. It's been great.
Thank you, Adam. It was fun.
All right, it was fun. And everybody else, thanks so much for watching.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to, 2% of it, silver would be $70 or so, But But gold will be going up during that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position, we said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100, $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally. and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor. The dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was the declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work, and if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls. All credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15-to-1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the end-game investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland-Allison Act, 1878, and Sherman Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15-to-1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've been talking about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading in the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor, for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, the dollar has collapsed. It's going to be at a 15-to-1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two 3. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively and almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the bank system functions. Well, I mean, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like, if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So, might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting. They're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something. Or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, so then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. And that's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. It's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, but you can't go completely into their world. But you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to it's a very difficult position where we are, because we have to put a leg in the illusion and we have to keep a leg out of it and keep our minds together, which is, it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me, that only I think like in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.